Right, hi everyone. Welcome to Foulger Underwood's latest live M&A market update. So I hope you can see the shared screen. Keith, can you say hello to everyone?
Hello, good afternoon, everybody. Good to
Very
see you
good.
again. And for the new entrants, new attendees, welcome to the update.
Wonderful. So my name is Kevin Reed, and over the next 40 minutes or so, I shall be asking questions of Foulger Underwood MD Keith Underwood, who has already done his intro. So that's all good. We're moving along very swiftly here. The questions will revolve around the M&A market for the accountancy sector in the UK. We've got a lot of ground to cover over the next 40 minutes or so, so I shall wiggle on. We will talk about consolidators and supply of firms that they're looking to consolidate. We'll discuss smaller firms and the opportunities and threats that they face, and we'll, of course, give a rundown on valuations, but there will be a particular slant around digital practices. And there you go. You should be able to see on the screen. There's us in all our glory with our topics. Right, and for those of you who don't know, Foulger Underwood is a leading advisor to professional services firms, helping them with M&A advice through to succession planning, strategy, and leadership development, among other things. So please visit foulgerunderwood.com to find out more. Some very, very quick housekeeping. We're very happy to take questions. We, of course, welcome them. Please use the Q&A button to send them in. I'll broach them as they arrive, certainly if they fit the flow of conversation. If they don't, I shall keep them for the end of the session. And today's session is running 40 to 45 minutes. If you have any questions that I guess you deem as sensitive, or you just like to have a catch up with us, then please drop Keith a line at keith@foulgerunderwood.com. And for those of you that are watching the recording of this, then drop us a comment in YouTube or drop Keith an email. So our first topic. PE-backed consolidator deals. Is supply keeping up with demand? Keith, we're on the right screen now, aren't we?
We are, yeah.
Very good.
Thanks very much,
over
Kevin.
to you.
Thank you, Kevin, and thanks for the introduction. It's been interesting, actually. I look back over the last 4 months, or 5 months since the last 4 months, I think, since the last update. And there's been a certain heightening of activity, particularly on the PE side. And I just mentioned a few here, because people are being bombarded by the PE-backed consolidators. And it's quite interesting that a certain amount of fatigue is setting in. This has been going on now for maybe 6-9 months in this intensity. And I think people have, although they need to keep aware of what's in the marketplace and what is on offer, each of these deals from the consolidators is different. Some fit, some don't fit. And of course, a lot of firms have now already determined they wish to remain independent for the next few years and maybe consider it in the future or not consider it at all. So some of the deals that have gone through, just to remind you, in the last 4 or 5 months, just to get the idea of the activity level, Assets have completed their part sale, or HG Capital have completed their part sale of Assets by bringing in another PE house. Kingston Smith have taken in money from Waterland to develop their scale in the UK. Duncan and Topless in Lincolnshire have taken in some money from Blixt to spread themselves nationally. TC Group have got some money from Inflection, quite a strong PE house, who've now gone into TC Group and to assist in that development. Cooper Parry, looking at some of the deals, Cooper Parry from the businesses themselves. Cooper Parry have bought a number of Haynes Watts offices in the last 3 months in the southeast, which has sort of split the Haynes Watts population. Fortis, which was actually a split off from Haynes Watts a few years ago, has sold some of their offices to TC Group. And just to make things a little more complicated, Tenzing, who obviously bought Jeffries Henry initially, Tenzing being the PE house, followed it up with ABG and CBW acquisitions, rebranded as Gravitar, and have now gone off in another separate investment and bought into Mitten Clark, who've done a number of deals since that investment. So they've actually got a PE house with a two-pronged approach to the marketplace geographically, I think, because the initial investment for Gravita was in the southeast, and the investment in Mitten Clark is meant to be Midlands of the North, but somewhat confusing. So the marketplace is very dynamic. And I suppose we talk to the PEs themselves. We're still talking to a couple of PEs who haven't entered the market yet. So it is very active. It is becoming quite saturated, to be honest.
Heath, I was going to say, is there capacity to handle all of this? You know, are we hitting the kind of limit here?
Well, when you look around at the people the investors, the investment businesses, the roll-ups who want £30 million firms, there are most likely not enough £30 million firms in the marketplace to satisfy their needs. And two or three of those are looking for initial investments in a particular geographic area as a hub, and then, if you like, what they call spoke investments in smaller firms to latch on to those businesses. And yes, I mean, see, I'm not sure where the market research has been for some of these consolidators. Somebody quoted to me the other day that they reckon there are 3,500 3,500 practices in a very fragmented marketplace. But actually, if you look at the sort of number of practices over 10 million, you're talking in the hundreds rather than 3,500. And some of those obviously don't want to go and wish to remain independent. So I'm not sure. You know, my belief is that in 2 or 3 years' time, when these PE houses do the flip, 3 or 4 years' time now, you'll find that they will most likely consolidate themselves, and with PE houses who haven't perhaps achieved their objectives, haven't spent all their money, who will be buying other roll-ups to achieve that scale, which is so important for them in driving the EBITDA on the bottom line, which of course is all they're concerned about down the line when they do their flip and look for a new investor.
And just as an aside, on Tenzing, there's been no noise about them consolidating their two consolidations as of yet.
It's been a bit early for that. I mean, say the second line of investment has only taken place certainly in the last 4 months. What their ambitions are, I don't know. You would think logically they'd want to bring them all together under one brand, but they've just launched a new brand, Gravita, and they're continuing with the existing Mitten Clark brand. So, you know, I mean, say questions on a postcard. Answers on a postcard. Sorry, it's many questions. So I'm not sure where that will go, but obviously when they flip it, they'll either flip it as two separate businesses, or they will flip it as a consolidated business, which means that one of those brands will have to go, and there'll have to be more consolidation in the next 3 or 4 years within that investment. So there are about 16, which is not too dissimilar, 16, 17 PE houses in the marketplace doing roll-ups. And if you broaden that, there's 2 or 3 that haven't got in the marketplace. I was listening yesterday to someone who said they've been approached by a couple of Scandinavian PE houses who also wanted to get in, which were actually outside our horizon. So there are a number of new entries in the marketplace who seem to feel that the market is ripe for coming in, making an investment, and effectively making a turn in 4 to 5 years' time when they sell on at a higher PE to another PE house down the line. So it is an attractive situation. I mean, say the actual benefits of looking at PE money coming into a sector such as the accounting sector is that normally PE are looking for changed business models. They're looking to extract greater profitability, and they're usually coming in trying to get a much higher margin out of the business than perhaps was previously obtained by the existing management.
What is it? What is the change dynamic, would you say, Keith? Is it around the use of technology and?
Well, they will invest. They will say they're investing in people and technology, and providing that back office, which perhaps those firms they've bought out could not achieve. But actually, the benefits of doing that are very limited. I mean, so you can't get away from your selling time. Basically, they're still selling time as a PE house, even if you're in a roll-up. So we always say there's a synergy benefit out of a merger of perhaps 15, perhaps 20% over 3 years in terms of reduced costs and efficiencies. But it's not a major play where you can get a 50% increase unless you really concentrate very clearly, get rid of half the clients and concentrate on a particular sector of clients.
Yeah.
Then you might achieve more, but that's not what these PE houses are doing. In fact, we've approached a few of them about selling off certain aspects of the businesses they've taken over, and there is just no appetite for that. They are driven to get the EBITDA up, and obviously divestment at this stage is not on the cards.
But so still relatively generalist.
Very much so, still relatively generous, offering a broader service as possible. It's interesting that Assets or Baldwins, as they started out, they were fairly channeled into GP business. They did not want insolvency or turnaround business, and they did not want wealth management businesses, which might have been attached to their acquisitions. And they dropped those. They've gone back into wealth management now and insolvency. So things do change as the investments develop over time. So yeah, but broadly, they're wishing to continue to offer a better service to existing clients, bringing on new clients, and it is no different to any other LLP merger really in terms of their objectives. But they do feel they've got this play at the end where they can buy at one level of PE, which we'll come on to in a minute, and sell off at a much higher PE to another PE house, having held it for 4 or 5 years.
So we've had a questioning, Keith. I think I've got an answer to this one, but I will kind of put it to you first. So someone has asked whether there's a list of these deals that we can share for them to then monitor. But I guess the answer would be attend our updates, and we'll keep you abreast of those as they develop. And of course, there's also a lot of PR around the PE work, isn't there? They do like to talk about the deals.
Yes, I mean, say PR wish to encourage deals by posting their successes and obviously putting it through the various media sources to make sure people know they're moving forward. I mean, say you've got to realize that these management teams have been allocated funds to invest, and therefore it's a success if they make an acquisition. And therefore that encourages people perhaps to consider that party as a suitable purchaser in the future. So it's sort of self-developing, self-marketing by these management teams supported by the PE houses. So yeah, there is a heightened awareness of it. Whether we can provide a list, I mean, so you've got to realize that the list I've just been through is only I would say we've most likely got the major deals there, 60% of the major deals in the last 3 to 4 months. It has not included all the sort of smaller deals that the PE houses are doing on their roll-ups anyway. But yeah, there's a lot of activity out there, and certainly most people will have been approached. Some people are being approached weekly or certainly twice a month to see whether they want to enter discussions. So on that list, yes, we have lists. Obviously, we need that to track through our database and approaches and marketing. We wouldn't necessarily want to disclose all those in a form for any of the attendees today. But yeah, we're always happy to talk on the phone. We're always happy to discuss these sort of things. And the next one of the updates will be in February. But I think the other aspect to go on to in the activity side, just going down this agenda, is that the LLPs have woken up. So when I say independent LLPs, these are people who are continuing to grow. They are managed owner and own their businesses. They have not taken in PE money. And there's an increasing activity at that level. And interestingly, they are increasing for buyouts. They are increasing their EBITDA offers towards the consolidators, obviously not paying the top consolidator price, but certainly, as you'll see shortly, you've got deals going through at 5 times EBITDA for an LLP business, And the people who've been in recently, there's been press announcements on Menzies doing a deal, MHA doing a deal, just to mention two. That's McIntyre Hudson. So they are on the acquisition trail as well. And obviously there are differentiations between selling to an LLP and also selling to a consolidator. I would say, the consolidators have provided a lot of money for mid-sized firms. They've made available a lot of money to buy out mid-sized firms, which would just not have been available in the marketplace pre-COVID, apart from assets, of course.
So we're just over 1:45 here. So we've been running for 17 minutes, Keith. So let's keep this wiggling on so that we can get this all covered. Shall I go on to the next slide?
Yeah, I think so. I think it'll be a good idea. Let's have a look at the PE multiples on offer. So what I've tried to do here, when we're dealing with EBITDA here, PE multiples on EBITDA, and the first one, of course, is not a PE, private equity. It's independent LLPs that we've just been talking about. So they're still doing three exceptionally 5.5. We've done just one deal on 5.5. So I put in there 3 to 6 times EBITDA. Remember, EBITDA is after a notional charge for the partners to produce generate the fees. So it is taking into account a sustainable EBITDA for the future. So when you get down to the PEs, UK PE, hubs and bolt-ons, I've split these because the foundation businesses are attracting more higher value. And by that, I mean, if you've got a 30 million pound practice, if you've got a 100 million pound practice, and a new PE house would be extremely interested, and they would go to 9 or 10 times. Somebody mentioned 11 yesterday, but I haven't actually heard that directly from the PE houses. They would go to perhaps 9 or 10 as a multiple of EBITDA. And the idea there is the foundation business would most likely provide the management team to go forward, and the management team would be tied in with a little bit of equity in the holding company, which they would be able to trade in 5 years' time or roll over again to the next PE house. So it does involve, the foundation business does involve management. And certainly one party of 10 million we spoke to a little while ago were actually being considered as a foundation business, but strangely enough, their management did not want to go through the 5 years, actually with the responsibility of managing and bringing in new acquisitions.
So does that lower the premium then because the risk is increased, Keith?
Well, then they become basically a hub, which is the next line down. So they most likely got 6 to 8 times multiple and went in as a hub and didn't provide management to the central management team. So that's a lower multiple. And of course, then you get the PE bolt-ons at the lower end, which usually are between 4 and 6. And the whole concept here for the PE house is you're willing to pay 9 or 10 for the foundation business, but you really want bolt-ons after that at 5 to 6. So when you sell in 4 to 5 years' time, your average PE on the total business, as you will do multiple deals on the bolt-on side, your average PE might be 7, and therefore you try and get out at, well, there's the assets figure there for the part sale of assets, 13 to 14, which I suppose is a benchmark for where the PE houses will be looking, although some of them have mentioned 15 or 16. But I think that's a bit ambitious, and they're looking forward 3 or 4 years.
We have been asked a question. I'm sorry to interrupt you, but it kind of just touches on before you got to the assets part sale. Yeah. But someone basically asked whether the kind of rates that are being paid, the premiums by the PE houses, where is that heading? Would you say that they've framed the question as, will these drop as we go forward? But yeah, which way do you think it will go and why?
Well, I've got something down there. Our Singapore and Hong Kong offices have been dealing in this sector since 2009, 2010, with corporate services businesses, the likes of Vista and TMF and people like that. And we're out there, which is a higher growth market compared to Europe, and it is also a lower tax market. We've seen multiples of 15 there. Thank you, Kevin.
I pressed a
We've
button,
seen
sorry.
multiples of 15 there. And it's a factor of the amount of money around available to the PE houses. That money is tightening to an extent with increased interest rates because most of these PE houses are geared. So yes, there will be a constraint possibly of a couple of percentage points, but there's so much money around at the moment that I can't see it dwindling unless PE houses are taxed in a different way. We've seen one roll up in Asia fail, and the business is sold off again back to individuals in the remaining management. So it was unwound as a roll up. It was unwound, and of course we've got the history. Although they didn't go to PE money, they went to the market of our friends Vantis, Tenon, and the two others that went to the UK market in 2001, 2002, which of course all failed. So I think, will the money be around? It's a question we're asked quite frequently. Should I go now or should I wait for another 4 or 5 years? I think there will be money around in 4 or 5 years. And the other factor here is that the PE houses are allocated money to spend. So there's a surge at the front end. Around year 3 in their 5-year cycle, they start looking at rationalization and improving that bottom line EBITDA, but also loading up additional acquisitions. So it is possible, we've had experience of this elsewhere, that they will offer a bit more as they get into year 3 or 4 of their 5-year cycle to achieve the sort of levels of EBITDA in dollar terms, that they achieve the levels of EBITDA they're looking for to go to the market the following year. Year 4.
Without wishing to go on to a tangent, Keith, but do they invest in acquisitions as much as I'll rephrase it? Do they invest in the creation of synergies or efficiencies or improving the bottom line as they do in the actual acquisitions themselves? I guess that's kind of quite a key question.
There's a very interesting discussion with one PE house who wanted to impress on me that they were not just buying acquisitions and accumulating them together. They were actually buying a business and wished to invest a higher percentage of the money in people and services and getting clients organically. So there is that differentiation. It's a very good question, Kevin, as to where some of these roll-ups are going. And of course, to an extent, Assets is a prime example of adding 80 businesses together over the years through Baldwin's and then Assets. We're not necessarily rationalizing them all fully. You're still going through the evolution, which is an evolution. I mean, so you always can improve businesses.
Yeah.
You're going through an evolution to improve the bottom EBITDA line. But then again, you don't want it to be perfect because you want the next acquirer, the next PE house, to be able to take something out of their acquisition to give them a launch pad for further acquisitions in years 5 to 10. So you don't want to have a perfect situation and sell it at the top. You actually need to leave some improvement within the business to be realized by the next acquirer.
Should we end the share screen, Keith, and move on to, because we're running at 20 minutes left, so we need to keep wiggling and discuss deal structure briefly?
Yeah, fine. Yeah, carry on.
Go for it then, Keith. Tell us about these percentages and why they're important and how they differ.
Yeah, I think the deal structures, and I said at the start, you want to look at these very carefully in terms of what each PE house is offering and the differentiation between a PE house and an independent LLP buying you. The independent LLP is quite a traditional model. So 5 partners, 2 want to exit. They get paid out by the independent LLP for cash, as I say, at a not too bad a multiple these days, if you find the right purchaser. And then the remaining partners are basically merged in with the LLP. But that gives them, providing they've got a reasonable profit share in their existing business, that gives them the ability to earn much more than they would get over, say, 10, 20 years they might have left in their career, much higher salaries and profit shares than they would get through a sale to a PE house. And that is a differentiator. And that is what is coming back usually when we go to someone and say, what are your intentions? What are your strategies? Those who want to stay independent basically say, look, we've got very good profitability. We can grow that profitability. We know where we're going. And more importantly, we've got a younger team who want to remain independent and steer this business in the future. And that's the differentiator between that and selling to a PE house. Now,
but it's got to be about having a clear handle on your strategic direction, your succession planning, your pipeline of people you're offering to clients, and the margin you make on that. And of course, many practices don't have a handle or grasp on all of those, do they?
No, they don't, but they are becoming more, what should I say, commercial in their management anyway, and those sort of areas are becoming very much to the fore. You know, we've got a lot of independent LLPs who are looking at downsizing their fee portfolios and getting rid of bottom end fees. You know, that rationalization, which might not have taken place 8 years ago, maybe, well before pre-COVID, is now going through many. There aren't many firms who are not looking at that in the reasonable 5 million plus area. They're looking to get rid of those non-performing and release resources to the much more higher value clients who actually hopefully will give them higher margins. So that's sort of internal. It is no longer a continuation status quo situation practice management wise. It is becoming far more aggressive, even if you're an LLP.
Minority stakeholdings, does that happen, Keith?
Well, you can do it with an independent LLP. I mean, see, we've just seen one done with an independent LLP for various reasons, and they've bought into 40%, and it all made sense in terms of strategically for the ongoing partners in the independent business as well as for the acquiring LLP.
The royal they being a PE house has bought.
If you're talking about a PE house, that is rather different. You may get a deal, and we've had one discussion 9 months ago about a minority holding, but it has to be with an option to buy in within a period of time before the next flip, if you like. So
seems a little bit of a half and half, not one thing or the other kind of situation.
Well, it is, and to be honest, the complications of it going that route will certainly make it not worthwhile for the PE house anyway, unless it's a really substantial investment.
Keith, we're running at 1 o'clock. We've got 15 minutes, so let's keep moving. Shall I share the screen again?
I think we just need to identify a couple of things on these differentiations between the LLPs and the PE houses.
Yeah.
We've mentioned one of them, which is the opportunities for the younger partners. The other one is when you look at those PEs, you might go back one slide if you can, Kevin.
Yeah, bear with me.
Go back to the previous. That's right. No, go on, forward one.
Back to the multiples.
Okay. So when you look at those PE businesses and investments, they are usually doing it on a debt-free, cash-free basis, but it does mean that you leave in the business your working capital. And it's interesting that we've had one deal, certainly, where an independent LLP came up with a multiple which was lower than the PE house. But when you take into account that the independent LLP was going to pay out work in progress and debtors, you actually had, there was a £300,000 difference in the financial offering. So that is something to be aware of. I'm not suggesting that you should have high work in progress and debtors, because that creates a problem in itself. But it's if you're going to give away that as part of the deal, because it's included in the PE houses, the PE house believe it's included in the multiple, then you have to do a comparison with other opportunities in the marketplace.
We've had a raised hand. Sorry, bear with me 1 second, Keith. We've had some raised hands. Guys, can you ask us questions through the Q&A, please? Thank you very much. Happy to broach them.
So we can go on to the next slide then, where we get back down to these independent LLPs who are still active in the marketplace. This one here, yes. So all I've done here is just saying, how's the attitude of these LLPs pre-COVID and now? And these are LLPs with sort of, I've chosen 10 million to 100 million, where there are still a number of independents out there.
And this effectively is our second topic. This is kind of leading towards the smaller firms' challenges and opportunities as far as M&A is concerned.
Correct. And that is the area that these independent LLPs are looking at really as the target. So geographically, pre-COVID, somewhat restricted geographically, much more open now, working from home situations. So they're willing to consider far more distant opportunities, providing the opportunity is commercially run. And down there for the portfolio, item 4, portfolio and digitalization, much more emphasis now on paperless, really concerns with these LLPs in terms of converting people from paper to non-paperless. It's too much of an investment. Digitalization of the clients, the amount of the client conversion to digitalization is coming up in these discussions, even in the first meetings these days, because people just don't want the cost of converting those clients and the risk of converting those clients. And minimum fees per office, which you used to be able to sell a 1.5 million pre-COVID, early 2010s maybe, at 1.5 million as a separate office. It's now gone up, so you've got scale, you've got new offices of 3 million to 4 million as a minimum. And the multiples, which is coming back
Keith,
to
just to clarify on that, so what's happening to those £1.5 million firms is your point that they're then getting subsumed, they don't sit as a separate?
Well, this is for £10 million firms. So the market for the, if you like, 500,000 fees to 1.5 million is actually with firms of doing 4 to 5 million, with 4 or 5, 6 partners, that sort of size. Whereas these ones we're considering here are larger. There's still a market there, absolutely, and it's quite an active market at that end of the market as well, at that end of the scale as well. And multiples for these 10 million, yes, well, that's what we've discussed before, 3 to 4.5 previously. Now it's 3 to 5.5 or 6 exceptionally.
And those multiples are EBITDA, I take.
Yes, they are. Yes, absolutely.
Important
Kevin.
Point.
And we'll come to that in a minute, the equation between the two, the old money and the new money. So we might go on to that slide.
Yeah, do you want to go into valuation?
I think so, yes.
Let's do it.
So I mean, see, people ask the question, which Kevin's going to in a minute, I think, as to why people deal with multiples of fees or EBITDA. Certainly,
I don't need to ask that now, but obviously we are all very comfortable with fees. Vanity rather than sanity.
It is a very odd measure. I've never understood why the professional service sector has always been going on fees. If you give me a £1 million practice, I can show you where it makes a return of 15% after notional costs at the bottom end, and another one with 1 million, which makes 30%. So goodness knows why people would value it on fees if the structure costs are totally different in generating the profits. But I mean, EBITDA is the standard form in the general commercial marketplace. If you've got PE houses, their investors understand that. It is a good measure of the sort of cash flow and repayment that you're going to have to make to cover your investment. And I must admit, I subscribe to EBITDA, even as a small business is right the way down to the sort of 500,000s. That's what I mean. If you're a managing partner with a proposition for your other 10 partners, they need to know whether they're going to be diluted or what level of additional profit share is going to be generated for them after taking off the cost of the investment. So, it is the way to go.
I do have another stupid question, Keith, for you. To treat you. Does EBITDA include the effectively the partners' drawings or their payment, their remuneration?
No, it includes the notional cost to generate those fees on the top line for that individual. So if there are 4 partners, it's an interesting point actually, because it's affecting the capital values that PE houses are offering as well. But the notional cost of the partner is usually up to say 120,000, unless it's heavily technical on tax or something like that, when it might go up to closer to 200,000. And that's a sort of southeast. You'd go to some other areas. I always say to somebody, if I was going to invest in your business and not do any work, any chargeable work, where would I go to recruit, and at what cost, an individual who can do exactly what you're doing as a partner? And that usually comes down to somewhere between 80,000 and 120,000. Might be lower in certain areas of the country. But yes, you're right. It does take a notional cost in there, and that's exactly what they do. That's exactly what they do. Sorry for some barking in the distance.
That's all right. It's not my dog this time.
So, yeah, I mean, that's how the EBITDA is calculated. And it's becoming an issue. We had a long meeting this week with a sale to a private equity-backed consolidator, who actually was quite open that they were quite happy for the younger partners to continue with almost the same profit share if they wished to in the future. So they were willing to pay out profit share, or actually salaries, if you like, at the 200,000 level. But of course, it made a big impact on the capital value that was going to be paid for the business up front, which affected the exiting partners who weren't going to work on. And there was a long discussion over what is parity, because quite often you find in this particular case, the younger partners only have a very small amount of capital in the target business, and therefore they don't get a big capital sum when the purchase is made, and maybe their profit shares around 100, 120 have to continue at that level without the benefits of the older exiting partners, who will take out a large capital sum because they own most of the equity. So we always say there's 2 or 3 deals in every purchase, depending upon how many different scenarios there are with younger partners, older partners, and the profit shares that have been practiced to date.
Well, we have been asked a question on that theme, Keith, which is what payment terms are being offered? Is a bullet payment an option? And how does it affect the multiple on offer? Quite a lot for you to digest.
Yeah, I mean, say there is every variety out there with the private equity. Let's just deal with the private equity at the moment. The traditional LLPs are still doing sort of 33% upfront for a buyout, 40% maybe, and spread over the next 2 or 3 years for the remainder of the deferred amount.
We've also based on certain targets being hit or maintained.
Based on certain turnover targets being hit, yes. In terms of the PE-backed consolidators, there are 2 things in this question. One, you can get 70% purchase, you get 100% purchase, you can get 51% purchase, depending on which PE roll-up you go to. And that is the remaining, the 51% purchase is prevalent with 2 or 3 of them, where they want to leave a significant amount, 49%, with the ongoing partners to motivate them and perhaps give them the profit shares that they previously benefited from.
Thank you for the question. Anyway, it's been nice having some questions during our session. We're going to be strict with our time, Keith. We have 5 minutes.
Yeah, fine. I just want to continue on that one because it is an important point. So the younger partners ongoing might get that at 49 if they hold on to 49% equity, but the majority of the consolidators are buying 100%. And then for ongoing partners, they might offer them 5% in the holding company, but not in the existing company. Then there's a 70% model where the consolidator buys 70%, and the 30% is left with the younger partners to be to be cashed in, if you like, on the flip in 4 to 5 years' time.
It's a motivational tool.
Absolutely, and it has quite good implications. If the PE house is going to buy at 6 or 7 and is going to sell at 15, there's a big uplift there for anyone, even if they're only holding 5%. So yeah, there are different models out there. The other aspect of that question is how do they pay? That's the sort of valuation and what the level of the equity they're going to buy. And again, paying, I haven't seen any lump sum payment up front. Not sure that couldn't be negotiated at a lower value, but normally they are paying 50%, possibly 70% up front, with the remaining 30% to exiting partners being paid over 2 years. So yes, there's more generous terms there.
Very good. Can we get this topic 3 done? We've got 3 minutes, Keith.
I think the other thing I'd just like to wrap up on is, apart from the activity that we've seen and we've discussed, there is also quite a bit of activity in service line sales. So we've had 3 or 4 larger practices asking us whether they should still remain in, whether payroll is still core to them, and whether the risks of payroll are really worth suffering as an in-house service, or whether it should go to a bureau. So we're currently, and we're in that sector, but it's interesting that it's coming up to the fore, it's coming to the top now, that some of the larger firms are interested in exiting from payroll. That's one aspect. The other one is wealth management, where people are trying to resuscitate their wealth management business, but realizing it's a high-risk situation. So there's a mix at the moment of people going into wealth management, or making sure their investment in wealth management, their business unit in wealth management, is efficient and is actually generating business out of the accounting portfolio, and or they're looking to sell it, because both those, payroll and wealth management, have a premium value compared to these PE multiple values. They have a premium value compared to a general practice. So that's one aspect. Just like to wrap up. The other one is digitalized, and maybe we won't cover it in this one, but we're having 3 or 4 assignments put to us for what we call entrepreneurial accountants who've set up purely digitalized practices over the last 5 years and more. They've built these to a certain level. They're in their 30s and they're deciding to get out. Certainly these 3 are deciding to get out and do something else and take their money and monetize it. And it's interesting, although there's a lot of promotion that this is the way to go, start a digital practice, have it streamed, have it entirely Xero or entirely QuickBooks, don't service people outside that, and have limited amounts of advisory service. When you come down to trying to sell this, the market is not necessarily reflecting what people feel is the value of these digital practices, because normally the main beneficiary here is the purchaser, who will take the portfolio. They will not give credit to a large extent for any premium value for the software that's been developed, and they will take the portfolio and put it on their own software.
Is that because most of the benefit scale? Is that because most of the benefit comes from the fact that someone's been able to set up quickly? That's the main benefit, and then of course you've then got a set of digitally focused clients, which I guess will have some premium, but beyond that, they're not doing anything so out of turn that there's a different premium attached.
Yeah, I mean, we've seen some which have got potential scalability on EBITDA, but of course, with these things, you have to invest in people, you have to invest in IT, and you're investing in marketing to a larger extent, perhaps, than the average general practice. So in those terms, you quite often find the EBITDA is a little suppressed from where you would expect it, although it's always anticipated to go up in a very steep curve. But if you're not interested in the software as a purchaser, some of that value dissipates.
I guess there might be some value if they have any proprietary tech, but again, if you're a small firm that's tried to move quickly, you're unlikely to have made that kind of investment.
Well, that's the problem. I mean, see, proprietary. If you may get a purchaser who has equally got proprietary tech, who is not interested in your tech, however much you've invested in it, unless it's significantly superior. And of course, that's a matter of investment and where people have gone and what sort of profits are generated out of processing through that system. So the tech angle sounds good at the start, but actually it doesn't necessarily give you the return. And in fact, I mean, so just as a final point, we often end up just discussing the tech side on the basis of removing the tech and selling it or licensing it to other accounting practices as a separate business, if it's that good. And therefore they go off and license it to other accounting practices and still sell their portfolio elsewhere.
Because the benefit of that is the scalability of it, or the ability to roll it out to other practices.
Yeah.
We've had one more question. We're running at 17 minutes past, so I think we've done pretty well there. Thank you to everyone for sticking around. Let me just ask this question. Obviously, it's the end of the session, so it's the time to kind of wrap these up. It's a bit of a technical one, but if you can keep it nice and brief, Keith. The differentiation rationale of working capital requirements in both LLP and larger PE deals.
The rationale, well, if you're a vendor, you can usually get the LLP to pay you the work in progress and debtors as and when it's realized post completion. In the case of the PE investment, they are normally looking to retain that if you like future cash flow to run the business. They are taking over an ongoing business with the working capital is needed to keep it going. So it's a big difference.
Yeah. And they don't want that taken out. Thank you for that question. Someone's also asked whether you'd be happy to share challenges facing smaller firms via email. And I think that I can answer that one. Of course, Keith would.
Absolutely.
Drop Keith a line, and he's always happy to chat with you.
I mean, we spend half our time every month, talking to people about their strategies going forward and the challenges. Pinch points and challenges is a word we use quite frequently, and how we can assist people in moving away from that one way or another, which might end up in M&A. It might not. It might just be a consultancy assignment. So we're very happy to talk people through their problems.
And so, as you can see on the screen, Keith's details are there. So please feel free to get in touch with him if you'd like to talk about your firm and its direction of travel. Otherwise, you can follow us on YouTube for more videos. You can visit foulgerunderwood.com to find out more about us or read some of our articles about accountants and practices. You can also find us on Twitter. Oh, it's not Twitter, it's X now, isn't it? I need to update my script.
Yeah.
X at Foulger UK. And of course, we're on LinkedIn. We've produced plenty of other videos. Please check them out. And this video will be archived and available for you to access again. We've had one more question in, Keith. Been a question fest today. Oh, it's just to say thanks. There you go. Few saved by the bell. Ladies and gentlemen, thank you very much for joining us, Keith. Final word.
Yeah, pleasure. It's always good to go through some of these things because it concentrates our minds as well for a day in preparation. So it's always good, but to impart it and get an interest from a group such as this is always very, very rewarding. Thank you very much for listening, and we'll be back again in 3 or 4 months' time.
Yeah, we kept that to 50 minutes. Not too bad. Thank you, everyone, for joining us. You'll get a link to this archived version of our webinar, and we shall see you again soon.